What is terminal interest rate? We've heard it a lot during Fed discussions and kind of Fed meetings, so that'd be interesting to know more about it.
Okay, so I have a chart for that. Oops, let's get Eason in here. So in this particular case, this is the futures market for the Fed funds rate. And what this is looked at is kind of the projection for what the peak interest rate might be, in this case, sometime next year. And a little hard to see this, but right now it's at about 5.1%. It actually hit 5.25% today, this morning. So again, right now the Fed funds rate's a little bit of a range, 3.75 to 4%. And so what they're saying here is that it could go to 5.25, which is actually a lot more than the Federal Reserve had projected in their last summary of economic projection, which was 4.6, 4.7% back in September. And Chairman Powell actually alluded to that in this meeting without saying any numbers. The next summary of economic projection comes out in the next meeting in December. They only do those every four times a year. So we'll see what they come up with their projections. Oftentimes, the Fed has actually been quite wrong in their projections. This futures piece has actually been much more accurate because there was a point in time, even September of last year, where the Fed said they weren't going to raise rates at all in 2022. Yet this futures thing had a projection that they were going to be raising rates quite a bit, and that turned out to be true. So when they talk about this peak piece, it's kind of important. Chairman Powell, Federal Reserve Chairman Powell, talked about there's three main things: how fast they raise the rates, how high they end up getting to, kind of that peak rate, terminal rate in this case, and then how long they keep it there.
Yep.
And so the focus has been on pace. Everybody's talking about what's going to happen in December, and he said the pace is no longer that critical, in his opinion, because they've already come quite a ways. He says it's much more important to focus on the peak and then how long we might keep it there. And so this is showing the peak terminal rate projection, and this is something to follow. As long as this thing continues to go up like this, and you can see that 200-day moving average, that blue line there, this is going straight up, right?
Yep.
As long as that continues to go up, the stock market is going to have a really hard time going from a primary trend down to a primary trend up, right? So this is a chart that I watch, just like the two-year Treasury, and they're very correlated, actually, if you lay them on top of each other. But just because until this turns over and there's some expectation that interest rates have peaked or coming down, this terminal rate is now going to be the thing we probably talk about more than the pace. Are they going to do 3/4 or a half or a quarter? Or what? It might not matter that much because we're already close to this terminal rate. Now, I will say this terminal rate's still going up, right? And so it went up last week. It's been going up last month. And so the terminal rate might actually be higher than 5.25 before we finally get there. And so the Fed thinks 4.6, 4.7. They may end up going to 6. Because inflation has been quite sticky, and because we've seen that core inflation continue to come up. So it's a really good question, too.
Yeah, one way to think about the interest rate in the Fed is the Fed's steering a cargo ship. So, and interest rates are kind of like your steering wheel. You can turn that steering wheel as fast as you want, but that cargo ship is still not going to turn on a dime. You still got to take some time to turn that ship.
Well, yeah, that's really interesting, because during the question and answer session from Chairman Powell on Wednesday, that was exactly asked. They call it the lag. So how are you accounting for the lag? Because you're raising rates right now, and you don't really know, what's going to happen to the economy. The projection's usually around 6 months before they really see the impact of the economy. And so shouldn't you be pausing or slowing down just so you can see what the impact is? And he said something very interesting. He says that was very true in the past, even back in the kind of the 2008 timeframe. He says, but what's happening now is a little bit different. The market is responding so aggressively to everything that they even say that the lag may be reduced quite a bit. So a good example would be the fact that mortgage rates have already gone up tremendously, right? I mean, from around 3% to around 7%. And well before they were starting to even raise rates, we started to see mortgage rates come up. That's the market responding. The 2-year Treasury's at 4.7%. Theoretically, it shouldn't be when the Federal Reserve rate's at 3.75 to 4, but it's responding in advance of what it's seeing. And so that could create less of a lag, right? Where that cruise ship or battleship or whatever you want to call it might turn a little bit faster than expected. I thought that was really interesting commentary from him.